Thanks, Emily. So like Emily said, we're going to do our best to address all of the questions that were submitted beforehand, as well as try to address any questions that come up throughout the course of this webinar. We just want to remind everybody that guidance is changing daily on the Paycheck Protection Program. So the information that we're going to be sharing with you today and answers to questions, for the most part, are going to be our best interpretation of guidance that has been issued as of today. We are still currently awaiting final guidance from the SBA and the Department of Treasury on both the use of funds and the loan forgiveness. We were supposed to have final guidance earlier this week, and we hoped in planning this call at the end of the week that we would have that guidance already. However, that hasn't happened, but we still want to do our best to answer your questions with the guidance that we have available right now. So we just remind everybody that the information continues to be clarified and is subject to change. We are also not providing any legal advice. So if you do have a legal question, we recommend talking with a lawyer, and the information that we are providing is just general ideas and considerations and best practices based on our knowledge and our interpretation of the guidance that has been issued. With that, we will go ahead and jump into some of the questions already submitted, and you'll likely continue to have throughout the course of this webinar. So Melody?
So let's start off with the basics. When should we consider the origination date of the loan?
Sure. So the origination date of the loan is going to be the date that your loan was approved. That's going to be the date that interest typically starts accruing. There is an 8-week covered period, which we'll talk a little bit more about. You've probably heard a lot about the 8-week covered period. This relates to the period of time that you can use the funds to have them included towards a potential forgivable portion of the loan. That 8-week covered period starts the absolute day that the funds are dispersed into your account. So it's not the date of the approval of your, it's not the submission date, it is the date that the funds actually hit your bank account. That is when the 8-week time period starts.
Perfect, and I know we will talk more about the 8-week application, but let's go to payroll costs because that's obviously a huge one and there's been a lot of questions about it. Why don't you give us an overview of payroll costs, and whatever isn't covered, I'll jump in with some more questions.
Sounds perfect. So the PPP loan is very specific in that it only covers eligible costs. So you can only use the PPP funds for very, very specific things. Now, we have pretty good guidelines of what those specific things are. However, there are still some questions that remain, which we'll address in some of the questions that were asked. At this time is the eligible costs include 2 buckets. There are payroll costs and there are non-payroll costs. Eligible payroll costs include the following: salary, wages, commissions, or tips. It also includes other similar compensation, which we don't exactly have a definition for yet, so I didn't include on this slide, but there is potential that other defined compensation may be included. Gross salary is capped at $100,000 on an annualized basis per employee. Vacation, parental, family, medical, or sick leave is also covered. It is sick leave that is covered by the Families First Coronavirus Response Act. So you may have heard a little bit about the emergency sick leave and the emergency paid family leave. And those relate specifically to employees that are sick with COVID-19, they are caring for people that are sick with COVID-19, or there are some childcare stipulations where if your childcare is not available and you have to be taking care of a child because of the pandemic, you can be paid under the FFCRA. Being paid under one of those 2 paid medical leaves under the Families First Coronavirus Response Act, those wages are not covered by PPP because you're already getting a credit for them in a different part of the CARES Act. Severance pay is also an eligible payroll cost. In addition to employer payments for the provisions of group health care benefits, which we'll talk a little bit more about, the employer contributions to retirement plans, and employer paid state and local taxes. So for most of our listeners, the big one that's going to be covered in that employer paid state and local taxes is going to be unemployment insurance. Most states, if not all states, have an unemployment insurance that you have to pay into, and that's an employer-only cost. So the employee does not pay into that. It's an eligible payroll cost. The federal unemployment is not an eligible payroll cost. And then if you have any employer-paid local taxes, Washington, D.C. has some, New York City likely has some. If they are employer-paid state and local payroll taxes, they would be eligible payroll costs. The other bucket is the non-payroll costs, and that's a pretty limited bucket. Right now, it is rent, utilities, which are currently defined as gas, electric, water, internet, phone, and transportation, which transportation is a little bit of a question mark right now. Those are the included utilities, and interest on mortgage obligations. And I think we'll talk a little bit more about the interest on mortgage obligations as we get to some of the later questions.
Awesome. So what about is included, or what things are included in that group healthcare benefits?
Sure.
Disability?
Yep. So right now, the guidance is limited. So you're going to hear me say that a lot. Either guidance is limited or we don't have final guidelines. As I explained at the beginning of the webinar, we hoped to have final guidelines by today, and we won't. So like I said, we're going to be giving you our best interpretations of the information that's available. In terms of what is included in the group healthcare benefits, as it stands right now, the guidance says, benefits include payments required for the provisions of group healthcare benefits, including insurance premiums. Some have interpreted this to mean only the cost of a medical plan, so not dental, not vision, not disability, not a flex or health savings account. However, when I read it first, group healthcare benefits, including insurance premiums, would say to me that that's the cost of anything that is health related that the employer is paying. But I know that there has been some guidance that came out. As an example, if you're in the state of Wisconsin and you received a PPP loan from a Wisconsin bank, the Wisconsin Bankers Association had provided guidance to bankers with a note that said that they didn't believe that dental insurance was covered under the PPP loan. At this point, what we're recommending is that you just ensure that you're documenting. It is possible that all of the healthcare benefits that you provide to employees will be covered, but we won't know until final guidance is issued. So you'll want to just make sure that you're keeping copies of all invoices as it relates to the premiums that you pay for any healthcare that you provide to your employees.
Awesome. Now, one of the big factors too with wages is additional wages. What about hero pay or extra pay, hazard pay, any of those kind of classifications?
Sure. So at this point in time, again, we haven't heard much in the way of whether or not hazard pay is officially going to be an eligible payroll cost under the PPP funds. Since hazard pay has been such a hot topic these days, and hazard pay is typically additional pay you would pay your employees because they are coming to work at a hazardous time. For example, if you're a restaurant that's open for carryout service, so you have jobs available, but you don't have employees that are comfortable coming into work to be around other people or to be around customers. So as an incentive to have people come into work, you may pay them some additional hazard pay. At this time, again, it is not clear if that will be covered. However, I would expect that when the final guidance rolls out, something like hazard pay would be an eligible cost covered under the PPP program. Bonuses are a little bit tricky. So, you know, if you're looking to increase somebody's wages just by paying them a bonus that you wouldn't usually pay them, there may be some questions that come into play. I wouldn't recommend using that as a tool to get your employees back up to their normal wage at this point, because as per the information we have now, lenders will be looking at supporting documentation to prove that you got your employees back up to their salary that they were at before the pandemic started. So if you're just utilizing bonuses, those are likely going to be separated out on a payroll report as a payroll item, as opposed to it just being their normal salary or hourly pay. So you may run into some issues with eligible costs and forgiveness if you only use bonuses.
What about specifically sales commission bonuses or sales commission?
So with sales commission, that one's a little bit different when we're talking about tips that maybe restaurant workers might receive, or if you have an organization that has salespeople and they work on commissions on a regular basis. Right now, again, the guidance is not 100% clear. However, I would advise that if you have a commissions program that typically pays out commissions on a regular basis or tips on a regular basis, you're going to have to justify how you got to a regular salary prior to the pandemic. So when you calculated the loan to be able to apply for the PPP, you would have included all commissions and bonuses that somebody receives. Now, if it is your typical practice to be paying out commissions on a regular basis, I think there's going to be a lot more leeway for you to be able to pay out commissions, even if the sales aren't happening, to be able to get people back to a normal pay salary. If you typically only do commissions or a bonus once a year or twice a year, I think it's going to be a little bit more difficult to justify why you're paying somebody those commissions or bonuses at a random time throughout the year. So you're just going to, again, want to be documenting, and making sure that, you know, you've got a trace for every dollar that you've spent. But at this time, in terms of bonuses, commission, and hazard pay, there is not final guidance available.
Great. What about 1099 labor?
So 1099 contractors are not counted as part of eligible PPP costs. You were not able to use 1099 contractors when calculating the amount of loan that you were to receive. Just as in the same way that you couldn't use them to calculate the loan, you also cannot use the PPP funds to pay 1099 contractors. If you have a question where a 1099 contractor should actually be an employee, it could potentially be an opportunity to hire them as an employee if legally they should be an employee of yours. You're going to want to be very careful if you hire them on as an employee and they fit the definition of an employee. You're probably not going to be able to go back to paying them as a contractor because you shouldn't have been paying them as a contractor in the first place. So there are a lot of rules around independent contractors versus employees. As it stands for the PPP, independent contractors are not eligible costs.
Great. There's a question in here about the forgiveness. How is that forgiveness going to be treated as income and the corresponding expenses?
Sure. So, so the forgivable portion of the loan is tax exempt income to a business. So let's say you received a PPP loan of $100,000, and once the 8-week covered period is done, you've gone back to the bank and they've calculated the forgivable portion and they come up with $75,000 as forgiven. That $75,000 will be recorded as tax exempt income on your income statement, so it is not subject to tax. There is some guidance that was rolled out last night that stated from the IRS that the expenses that you pay for with the forgiven portion of the PPP loan will also not be tax deductible. The guidance came out last night, so we're really still digesting it. So there's still some more information that is likely going to come out, but this is a very important piece to be considering because before there was no guidance about this. So if you were thinking that you would have tax exempt income, so you wouldn't have to pay tax on the forgivable portion of the loan, but then you were also going to still be able to take the deductions, information would be a big shock. So you want to make sure that you're talking with your accountant. Certainly if you work with us here at Wegner, please be in touch with your accountant about this because this just came out last night. So it could potentially impact your 2020 taxes. But we want to be sure that we're providing the information that we have at this time. So as of last night, the IRS said, yes, they agree the income that's forgiven is not taxable. However, you will not be able to take deductions for the expenses that you used with the forgiven portion of the loan.
Great. A question came in the chat while you were explaining that related to payroll. Is it true that if you have a PPP loan, you can't take credits under FFCRA? And if so, does that mean all gross sick pay, including the FFCRA, is eligible to include?
So the FFCRA credits, if they're talking about the credits that you receive for paying people under the emergency sick leave or the family medical leave, those wages that you pay under the FFCRA are not eligible under the PPP loan. But the rest of the salaries that you're paying, not under the FFCRA, are eligible costs under PPP. So you want to make sure that if you are paying anybody under the family sick leave or the family paid leave or the emergency sick leave, as it came out through the Families First Coronavirus Response Act, you want to be sure that you've communicated with your payroll processor, or if you process your own payroll, you have set up different payroll items to be able to track which employees are being paid through the emergency sick leave and family medical leave versus the ones that are either just taking normal sick leave where it's not paid under FFCRA, or they're just getting paid normal wages, because you can take credits for those that are being paid under FFCRA. Those are still valid credits, even if you have the PPP funds, but you cannot use the PPP funds to pay for those specific wages. So it's all about tracking and documentation.
Awesome. I have two different versions regarding increasing pay. One, what happens if I want to increase pay now, but knowing that I'm going to have to go back and reduce at some point after potentially the PPP is forgiven. And the second part or secondary element is, what if it's just a new hire? Can I bring them on at a higher wage?
So the factors that will come into play all kind of depend on the dates that we've been given right now when it comes to reducing pay and keeping people on, keeping the same people on. Now, the loan forgiveness calculations are going to be based on a number of factors. One large factor that we're going to talk more about in a bit is the FTEs, so full-time equivalent employee calculations. Right now, as it stands, the idea is that you're going to be looked at, that you're going to be asked for your average full-time equivalent employees at a few certain periods in time, and they're going to compare that against the average FTEs you had during your 8-week covered period. And they're also going to look at how many people you've actually rehired as of 6/30/2020. So again, we're going to talk a little bit more about that. So in terms of whether or not you have the same people working or different people working, if somebody doesn't want to come back to work and you rehired somebody new in their place, the idea with the FTE calculations is that, from my standpoint, that shouldn't matter, because they're just looking at numbers of employees. As it relates to the amount of pay that you're paying people, if you have increased somebody's pay or you've hired on somebody new that's at a higher rate than maybe somebody that left or you let go, that also won't have a negative impact. Obviously, the loan calculation was based on an average of your payroll in a prior, if it was 2019 or 12 months from the 12-month trailing period from when you applied for the loan. If you are paying people more than what you were paying them last year, then the likelihood is you may run out of the PPP funds to cover payroll. There's the potential for that, or you may need to use all of your PPP funds for payroll and not for the non-payroll costs. So hiring somebody new on at a higher rate is certainly more than fine. As long as if somebody leaves or you fire somebody, as long as you replace them with a new person and you're paying them the equivalent of what the person that just left was being paid before the pandemic started, the guidance we have now, you should be fine.
Great. There's a question I don't want to lose in the chat here related to other costs. Is there any forgiveness or consideration for COVID-19 specific expenses like masks or cleaning supplies?
At this point, as it relates to the PPP funds, no, there's not. There are other rules that I I don't want to dive too far into because we have a limited amount of time and a lot more to cover. I would say go ahead and throw that question into the Q&A, and we can definitely make sure to answer that after, because yes, there are other options, but they are different parts of the CARES Act and don't fall under the Paycheck Protection Program.
Awesome. What if our employees are still working full-time when we got the loan? Do I just keep paying and tracking out differently?
Yep, that's correct. So the idea of the PPP loan was to be able to allow businesses and organizations to either retain or rehire. So if you haven't actually laid anybody off or furloughed anybody or lost any employees, that's okay, that's great. The purpose of the PPP loan is to help you cover the continued cost of those employees. So maintain as you have and track as everybody else would.
Awesome. So I think if it's okay with you, let's move on to talking about what incurred and paid means.
Absolutely.
For instance, somebody has an 8-week period, their funds drop midweek of a payroll. How do they handle that?
Sure. So incurred and paid has been a very confusing topic even for us as accountants, because incurred and paid really mean two very different things in the world of accounting. Costs incurred would typically mean you're on what we would call an accrual basis. So an expense is recorded in the period for which you incurred the cost, even if you didn't pay for it in that time period. So maybe you paid May's rent in April. That rent is still a cost incurred for May, even though you paid it out in April. Costs paid would typically relate to a cash basis of accounting, which means you're recording the expense when you actually make the payment. So in the instance that I just went through, if you paid May's rent in April, that expense is actually going to be on your books in April and not May. So the guidance right now literally states costs and incurred and paid in the 8-week period. So you could see why we would be confused about that, and we could certainly see why everybody else would also be confused about that, because it is certainly not clear. So like many of the other questions, this is still up for interpretation until the final guidance comes out. However, what we are advising is that eligible payroll costs would be based on the month, on the payroll check date, not so much the monthly beginning or the payroll period beginning and end date. So what I'm calling this is a mostly cash basis methodology. So the eligible payroll costs, let's say you received your PPP funds on April 30th and you have a payroll check date of May 1st. That payroll check date of May 1st is going to be an eligible payroll cost for you since the clock started ticking on April 30th. So everything that's related to that May 1st payroll check date is going to be an eligible cost for that 8-week period. So we're not going to care if that payroll period started and ended before you received the funds. We only care that the paycheck was actually paid after you received your PPP loan disbursement. So why I'm calling this a mostly cash basis methodology is because there are a number of other costs that are included in that payroll cost that hits on May 1st that you may not pay out until potentially after your 8-week period ends, or you may have prepaid it before, and now you want to make sure that you're still accounting for that cost. So as we discussed before, the gross payroll is the eligible payroll cost that's included, which means that on May 1st, if you paid $100,000 in gross payroll to your employees, the amount that's going to come out of your bank to pay your employees on May 1st is not going to be $100,000. Let's say $70,000. So all of the payroll taxes, the contributions to insurance or retirement plans, those payments may be made at different times, but they are still eligible costs as of that 5/1 date. So when I say mostly cash basis, I'm referring to the payroll check date, and there are other payroll costs associated that will be included even though you may not actually make that payment on May 1st. If you have a biweekly payroll, anybody with a biweekly payroll or a weekly payroll, it should work out that you have either 4 or 8 payrolls covered, regardless of when the clock starts ticking for you. So on a biweekly payroll, you get paid every 2 weeks, and you should, regardless of the timing, have 4 payrolls that are covered in that 8-week period. Same goes for the weekly payrolls. Regardless of the timing, you will have 8 weeks of payroll covered. The only issue that oh, sorry, go ahead, Melody.
No, that's okay. I was just going to add to it because there's a couple of questions that came in specifically around what you're talking about. If you receive the funds on the same date as a payroll check date, I think you've been addressing that. But then the other one is, what about prepayment, something that would typically be incurred after the 8-week period?
Sure. So if you are trying to make a prepayment for something, let's go ahead and use a group health insurance plan as an example. So some businesses may have prepaid for a year's worth of health insurance in January. So the reality is, in this 8-week covered period, you're not actually going to pay out any of those expenses. However, you are going to incur them because you take 1/12 of that expense with each month. So that's where that mostly cash basis methodology comes in, where if you have prepaid for something prior to the 8-week period, but it's an expense that will cover that 8-week period, you can take 8 weeks or 2 months worth of that expense, and it will be eligible costs during that 8-week period. If we look at it the other way, so let's say in May, you want to try to prepay for 6 months worth of insurance going forward. You're not going to be able to utilize the PPP funds for 6 months worth of insurance coverage. It's going to have to be prorated for the 8-week period that it's covering.
Awesome. How about we move on to FTEs?
Sure.
So by when do we have to have our FTEs back up for forgiveness?
So ideally, you would be able to rehire most or all of your employees when the clock starts ticking on that 8-week period. I say this because forgiveness will potentially be reduced based on an average FTE number at given points in time, which includes that 8-week covered period. They will potentially be looking at an average of your FTEs over the course of that 8-week period. So if you don't hire all of your employees back until the very last week of that 8-week covered period, that average number is not going to maybe be equivalent to the periods that they're going to compare it to. So ideally, the idea of this loan is that you're getting a loan so that you can rehire or retain all of your employees. There is potential, though. There's this June 30th date that's been locked in by a lot of people, even though we're approaching June 30th so quickly. If there is potential that if you rehire all of your employees by June 30th, your maximum potential for forgiveness will increase. Although, again, the guidance has not, the SBA and the Treasury have not defined the specific calculation that they will be using.
Awesome. Will forgiveness be prorated, or is it an all or nothing kind of thing?
So at this point, I would say it's all or nothing. Like we talked about before, if you fire somebody, I think that's actually the next question. So if an employee quits, fired for good cause, and a replacement is hired, can their wages be forgiven? So in that instance, I would go back and say, if you lose one employee but then hire a new employee, your FTE calculation is going to be fine. The question then still comes in: have you maintained people's salaries within 25% of what they were before the pandemic started? At this point, that's still up for question. The prorated question, I think, is going to be an all or nothing situation. I know we've talked to a lot of different clients who have many different situations. We did a webinar earlier. Somebody asked a question related to the timing of their workforce capacity. They received PPP funds, but on May 15th in every other year, their workforce capacity goes down because their seasonality changes as of May 15th. And they asked, would that impact their FTE calculations? Are there exceptions? Is leeway given because of their normal operating procedures? As it stands right now, I would tell you no. I don't think there are any exceptions, because this program was rolled out to such a wide variety of organizations and industries. It's going to be very hard for the SBA and the Treasury to roll out final guidance that addresses every specific issue. And I don't believe that lenders are likely going to make a lot of different exceptions and interpretations based on one particular client's situation. So I would advise that you keep that in mind, be aware that if you do have a seasonality issue like that, there is potential that your forgiveness could be reduced due to the fact that you aren't going to have as many employees during the 8-week covered period.
Great. There's several questions around how we calculate an FTE, what hours, and if you're a salary person, how it counts. Is it by people or by amount of payroll? All of those things, if you could clarify what that FTE definition is, would be great.
Absolutely. So FTE, again, stands for full-time equivalent employee. So typically when you think of a full-time employee, you think 40 hours a week. And that is a pretty standard definition. And at this point in the CARES Act, which is where the Paycheck Protection Program was rolled out, they did not define what the FTE calculation is as it relates to the PPP program. However, they did define it as it relates to some of the other credits that are available as part of the CARES Act. So our best interpretation right now comes from the guidance issued along with the employee retention credit, which we're not going to talk about in today's webinar, but is another option that's available for people. But in the employee retention credit guidance as a part of the CARES Act, they referenced Internal Revenue Code section 4980H. And that code probably doesn't mean much to you, but the definition will a little bit more. So the definition in that section, that IRC code, that Internal Revenue Code section, says that an FTE is an individual who works an average of at least 30 hours per week. An FTE is determined by adding the hours of part-time employees on a monthly basis and dividing by 120. So employees working at least 30 hours per week are counted as one full-time equivalent employee. If you have 5 employees that work 20 hours a week, you would want to add up all their hours that they worked and divide for the month, and then divide by 120, and that's going to give you the full-time equivalents based on your part-time workers. So at this point in time, that's the guidance that we have to work off of. Again, typically when you think of an FTE, you think of 40 hours a week. And so there is potential that when the final guidance comes out for the forgiveness, they are going to state that one FTE is equal to one person that works 40 hours a week. However, the guidance in other parts of the CARES Act identified this Internal Revenue Code section, which is what we just defined.
Awesome. What about the periods? What are the dates around when I calculate this FTE for forgiveness?
Yep. So in looking at what the potential calculation is going to look like as it relates to FTEs and the potential loan forgiveness, the information that we have right now states that you are going to take the average full-time equivalents during the 8-week covered period, and you're going to divide that by the lesser of the average FTEs during February 15th through June 30th of 2019, or January 1st through February 29th of this year. So they are trying to give you some sort of advantage by comparing these two different periods in time. So it's right before basically the pre-pandemic average FTEs, that January through February, versus what your average FTEs are for the same similar period of time that we're looking at right now in last year. So again, the numerator is the average FTEs during the 8-week covered period, and you're going to divide that by the lesser of the average FTEs during 2/15 through 6/30/19, or January 1st through February 29th of 2020. You're going to get a percentage from that, and that if you have a difference, so if your numerator is less than your denominator, there's going to be a percentage that your loan is going to be, the forgiveness is going to be reduced by.
Awesome. Sorry, trying to track a number of questions here.
Sure.
How imperative is it to hire back the same number of employees or the same employees versus new hires? And what about if somebody can't return because of childcare or health issues?
Sure. So, again, we have to go back to the guidance that we have. And when we think about FTEs, they aren't, there isn't any guidance that states they're looking for it to be the exact same employees that you had hired before. You just need to have an average number of FTEs that is in line with the number of FTEs that you had pre-pandemic or that time period in 2019. You have employees that don't want to come back to work and you hire new ones in their place, I think you're going to be fine. If you have people that have childcare issues or are sick as it relates to the coronavirus and COVID-19, then you should be paying them. You are required to be paying them through the Families First Coronavirus Response Act. There are some exceptions. Those in healthcare are exempt from the Families First Coronavirus, I'm going to call it FFCRA, the Families First Coronavirus Response Act, that emergency sick leave and family leave. There are some exemptions. Some organizations don't have to pay. However, if you aren't exempt from that, there is a requirement if you have employees that can't work due to 6 very specific reasons that you have to pay them through that FFCRA. Which you do get a credit for also.
Thank you. Can we talk a little bit about the 25% change in wages and how that applies if it's in whole or by employee?
Sure. So I know we had a question talking about 75% of Q1 wages. So the guidance that we have seen is that it's going to be applied by employees. So they're going to be looking at, did you bring back all of your employees back up to within 25% of their, we'll call it their pre-pandemic salary. So I don't believe they're going to be looking at it as a percentage of your quarterly wages. For one of the main reasons would be that obviously through March 31st would be the first quarter, January 1st through March 31st. And many states started going into safe at home orders before the end of March. So to look at the to look at wages for the whole first quarter would really, I mean, it just to put it lightly, it wouldn't be fair is an easy way to say it, but it also wouldn't be realistic because the PPP program didn't roll out until April 3rd. You couldn't apply until April 3rd. So there were likely many businesses that had to either lay off or furlough employees prior to even knowing if they could apply for the PPP loan. So the likelihood is that they're going to be looking at it on an employee by employee basis. That obviously goes back to the question of, well, what if somebody quits or we fire somebody, but we hire somebody new in their place? That's where I'm thinking that you're going to want to make sure that the salary is somewhat in line with what you were paying the person that either quit or was fired, because they are going to look at a reduction of wages. So it could be that they see that it's a brand new person and you're fine to be paying them a lower wage or a higher wage. Again, guidance is not 100% clear, but as it relates to the FTEs, I would say 1 in, 1 out, you're fine. There's not going to be any issue there.
A couple more questions have come into the chat, kind of back to the whole idea of FTEs as well as payroll. What if the employees want to be off for 8 weeks and get paid for staying home? Is that feasible? Can that happen?
It sure can. Unfortunately, one of the downfalls of the way that the loan program rolled out at this time is that Many states, most states are still under some sort of stay-at-home order. So the reality is restaurants aren't back open, retail operations aren't back open, non-essential businesses, that have been deemed non-essential may not be back up and running. So what are you supposed to do? You're supposed to pay people to not work. Unfortunately, that is the reality of this program. The idea was to retain or rehire employees. And if you are providing benefits to those employees, you would be able to continue providing those benefits, which should hopefully incentivize employees to want to stay with your organization to keep those benefits as opposed to applying for unemployment. So there are some pros and cons for both businesses and employees if there are benefits in play or if the wages were high enough versus taking unemployment. But unfortunately, that is the reality of the way that the program was rolled out, is that timing really doesn't necessarily work in a lot of organizations' favors right now, because there just isn't necessarily a job to hire people back for. But the intent of the program was that you would still be able to pay them. So yes, you may be asked to pay people to do nothing. So
what about the other side, though, if you have work and they don't want to return because unemployment's higher?
That is also a harsh reality that came out with the CARES Act, because there is an additional piece of federal unemployment that's now supplementing states' unemployment insurance, which for some employees may mean that there's potential that they're actually making more collecting unemployment. Is only being offered for a limited time, so they can't be doing that forever. But the reality is that that benefit is there, and it may be more beneficial for them and their family to continue collecting unemployment. I believe that federal assistance, I think it's available for 4 months. But again, it's the idea that employees will hopefully be incentivized by job security. If you're still able to pay them, even if they can't work, there's a good chance they may be more willing to stay on as an employee, knowing that they have a job and they have a job to come back to. If people choose not to come back to work, it is in your right to choose not to rehire them when work is open and available. So I hate to say it's a bit of a cat and mouse game, but unfortunately, that's kind of how this is playing out.
The one thing I would add there, though, is most states, for the unemployment, even with this increase, the employee has to sign certification each period that they are looking for work. And if they're offered work and turning it down, you're now flirting on the line with fraud and other issues, and you really don't want to go there as the employer.
Very true. I know that they're, like in Wisconsin, they eased up on those restrictions, but they are still there. I mean, those certifications are still there. So if you are offered a job legitimately that you had before, and you turn it down because you're making more money, you are opening yourself up to, potential legal action from the state. And if you're collecting that federal piece from the feds as well. So that's a great point.
A couple of questions about if business is going better than we anticipated, or we're just going to have to keep reduced payroll and we're not going to need all the funds. Can we pay back the funds that we're not going to use?
Absolutely. So you certainly can pay back the funds at any time. There are no prepayment penalties associated with the PPP loan. Same with the EIDL loan. I know we're not talking about that, but I just want to make sure that that's clear. There are no prepayment penalties for either of these loan programs. You know right away that you're not going to be able to use all the funds. You can essentially just give it back. Interest begin accruing right away. So there is potential that if you wait a week or 2 weeks and determine after 2 weeks that you don't need it, there's going to be a little bit of interest. Again, it's 1% interest, so it's incredibly minimal, but you can just pay it back. There is nothing saying that you have to hold on to it or you have to use it. You can just give it back.
Terrific. Now there's questions coming in about who ultimately makes the forgiveness decision and what are we going to have to submit in terms of documentation?
Sure. So I think along with that, I want to make sure that we, since an hour flies by so quickly when you have so much to talk about. So I do want to make sure that we talk a little bit about accounting and tracking as well, but this will also tie into documentation and Melody's first question about who is going to be responsible for determining the amount of forgiveness. So as we've noted a number of times, we are still waiting on final guidance on the loan forgiveness from the SBA and the Treasury. That is ultimately who is going to define what is forgivable and how funds can be used and how the forgiveness is calculated. So the banks are doing the same thing. Lenders and banks are doing the same thing that we are right now, which is interpreting the most recent guidance that we have. However, when the SBA and the Treasury define the final ruling for the loan forgiveness and the use of funds, bankers will need to interpret that, which hopefully is much clearer than the information we've received to date. And so ultimately, it will be your lender that is plugging your information, your supporting documentation into a loan forgiveness calculation and providing you with that number. You should have an idea before going into it, hopefully, of what that forgiveness amount should mean, because the final guidelines should hopefully come out before the loan forgiveness needs to start being calculated. You would have an idea, but you know, the biggest thing that I can recommend is document. I think I've said it on every webinar we've done. I can't say it enough. Obviously, as accountants, we tell you to document things nonstop anyway. Here's the situation where we couldn't mean it more. Supporting documentation is going to be absolutely necessary to substantiate the use of the funds. Tracking is going to be vital, which is why I want to make sure we talk a little bit about accounting and tracking. But then also just making sure you have, you know, a good list of documentation. So Melody, maybe if we can just go back a little bit to the accounting and tracking, and then I'll go through the documentation after we go through some of the tracking stuff.
Sure.
Okay.
What do you suggest in terms of the idea of having a separate bank account, or being able to just set up classes or use your software packages or a spreadsheet?
Okay. So ideally, Wegner, I believe as a whole, myself certainly, and I know Melody has as well, our absolute recommended best practice is to, if you're able, to put money into a separate bank account and use it similar to a clearing or holding account. This way, you can move money into your operating account that ties exactly to a payroll report, or an invoice from a utility company, or an invoice from your landlord. And then you have movement of money that matches exactly to a document that you can provide to your lender when it comes time for forgiveness. I recommend this so much for, you know, one of the big things that I think everybody is still working to wrap their head around is this eligible payroll cost being the gross payroll amount and not the net payroll. So when you have a payroll, you pay out gross wages. That includes, the gross wages include the employee withheld amounts for federal and state withholding, any employee contributions to health insurance if they are contributing to a retirement plan for themselves, their portion of the Social Security and Medicare taxes. All of those things are included in your gross payroll amount. But when your paycheck date comes and an amount comes out of your bank account, that's the net payroll after all of those deductions are taken out of an employee's gross payroll. So it's going to be difficult if you just deposit all of your PPP funds into your main operating account. It's going to be a little bit more difficult to tie those payroll reports that are eligible payroll costs to the amount that actually comes out of your bank account. But if you have it in a separate account, you'll be able to transfer the exact amount of those gross payroll costs into your operating account to cover the payroll. And then you're going to have a great paper trail to say, I transferred this amount because it matches this payroll. So that's really the biggest reason that we recommend a separate bank account. We also recommend probably tracking it on a spreadsheet. If you're a Wegner client and have a Wegner contact, we do have a very basic tracker that we put together And you can request that from your relationship manager here at Wegner. You have also seen some come from your bank, so be sure to be in touch with your banker. If you're using a software like QuickBooks, you're probably very familiar with classes. If you don't need to track these funds for any other program or department that you have, you certainly can set up a separate class for the PPP funds to be able to track it that way, or if you're not using classes, you can utilize classes in that way. There are still going to be salary expenses and rent expenses and utilities expense. So, you know, there is potential that you could put them into a different general ledger account, but you're also going to want to identify what they are. You know, if you have a PPP expense and then you have sub accounts, so you can do it that way as well. But it's really going to be easiest if you have it in a separate bank account, and then you can tie out those transfers to your operating account to the payroll reports and receipts that you have.
Great. Did you want to document or go to something else regarding the documentation? Or
sure.
Like
Absolutely, yeah. So let's just talk a little bit. I know we've got about 7 minutes left, so I want to make sure that we're finishing up with some of the questions that were submitted beforehand. So in terms of documentation, what we can expect is that you will likely be asked for payroll registers and reports. Again, the likelihood is that you're going to need those detailed payroll registers. So it's going to be a payroll register by employee. This is going to help with the determination of full-time equivalents, and also so that they can find out if there were salary reductions. You're also going to want to make sure that you're keeping invoices for your health insurance premiums, any 401k contribution reports or retirement contribution reports that you receive, and then invoices and potentially receipts. So receipts that verify that you actually paid for rent, utility, and interest on debt obligation costs as well. They may be looking at canceled checks to ensure that you paid them, or ACH files. I've also seen that some lenders are going to be requesting 941s and quarterly state unemployment reports, which will also show the number of employees that you had by quarter. So again, the more information, the better. So just make sure that you're tracking all of those types of documents and you have them on hand, ready to go when it's time to do the calculations.
I'm going to hop in quick. I know we still have a few minutes, but just to make sure we get all your questions. If you did submit a question today in the chat feature, we really want to make sure that we answer those for you. And I'm going to ask that you move those over to the Q&A, just because that's where we are going to run the report to answer all those questions. So in the last few minutes before we finish up here, make sure you answer or submit all your questions in the Q&A feature so we can get those answers to you. Back to you guys, a few more minutes.
Thanks, Emily.
A couple other questions about some of the other non-payroll costs. If I own my building and pay rent to myself, do I count the rent expense, or should it be the interest paid on the mortgage that's eligible for forgiveness?
So the eligible cost is going to be whatever is paid by the organization that actually received the PPP loan. So in that situation, it's going to be the rent that you pay to yourself that would be eligible, as long as there was a lease agreement in place prior to February 15th of this year.
What about dividends for smaller businesses? Are those eligible?
So at this point, I would say dividends are not eligible. They haven't been defined anywhere in the payroll or non-payroll costs. So I would say that they are not eligible.
What is the relationship with the EIDL and specifically the grant? What's allowed there?
Sure. So many people likely on this call also applied for the economic injury disaster loan. And want to make sure that everybody's clear in how these funding programs relate. So you can have both loans. You could have received the up to $10,000 grant through EIDL. You could have been approved for and received EIDL funds, and also been approved for and received PPP funds. The important piece to note is that once you've received both loans, you cannot use them for the same purposes. So that is standard guidance on any SBA loan program. Have two SBA loan, more than one SBA loan out at a time, but you cannot use them for the same costs. If you receive the EIDL loan prior to receiving your PPP loan and you used some of the EIDL loan to cover payroll costs, you will be required to refinance at least a portion of the EIDL loan into your PPP loan. If you received your PPP loan first, you use those funds for the specific eligible costs, and the EIDL program, it's a working capital loan, so you can use it for anything else to keep your business running. If you received the up to $10,000 grant from the EIDL program, that is going to reduce the amount of the loan forgiveness in the PPP loan. So it will automatically mean that you cannot have 100% of the PPP loan forgiven if you received the EIDL grant.
Great. Is there any interest allowed on anything other than a mortgage? And what about rent? Is that only on real property, or is storage, copier, other things eligible for that rent?
So that's a great question. I've seen varying guidance on that. Some guidance says interest on debt obligations, which would say to me that you can use it for real property, tangible property, or personal use property. At this point, the guidance is not clear.
I don't know if you heard, what about interest on something other than a mortgage or rent on the real property?
So if you have like a copy lease or cars, that is still a question mark. Some of the guidance says interest on debt obligations, which would say that the interest paid on a copier lease or a vehicle would be included, but there is no final guidance on that at this time. Again, just keep good records, keep documentation of those costs in the chance that those may be eligible costs.
We lost her for a little bit.
I think we might have lost Melody, but that's okay.
Maybe she was just done with us. Do you have any last minute comments that you want to say, Kate? I really appreciate everybody moving your questions from the chat to the Q&A, and we will do our very best to follow up with those today. And if not today, then Monday morning. But anything else you'd like to add?
You know, I think at this point, I know that there were a number of questions that were submitted beforehand that we weren't quite able to get to that were a little bit more specific. So we'll definitely look to address those after this as well. There's so much information, and we thought an hour was hopefully going to cover it just talking on this one topic, but I think we know for next time that we need to put this out maybe another half hour. But please make sure to submit your questions to the Q&A, and we're going to work to get you answers to those by the end of today so that you've got the information you need. And just continue to be on the lookout either on Wegner's website, or if you're checking the news when these final guidelines are going to come out from the SBA and the Treasury, because that's going to answer a lot of questions. And the likelihood is that we're going to probably plan to do one last round of webinars once the final guidance comes out, so that we can ensure that everybody has a clear understanding of what the final guidelines mean.
Awesome. Thank you so much, Kate. Kate and Melanie, you both did a fantastic job. We so appreciate your time. Thank you all for joining us today. We so appreciate all of your time. We get those questions to you and hopefully clarify some things to make sure that you guys are operating at your very best. So thank you again for joining us. Keep an eye out for the webinar recording and the presentation from today. We'll get those emailed to you. So thank you so much again for joining us, and have a wonderful rest of your day. Thanks, Kate.
Thanks, Emily. Bye.
Bye.